Every January, the same market phrase resurfaces: the January effect. The idea is simple. Stocks, especially small cap stocks, are supposed to perform well at the start of the year. But as with most seasonal sayings, the important question is not whether the phrase exists, it's whether the effect actually shows up in the data, and whether it's then reliable enough to matter for real trade decision making. So today, instead of repeating the narrative, let's test it. Now, traditionally, the January effect refers to a historical tendency for equities to outperform in January, with the strongest gains expected in small cap stocks. And the usual explanations that are circulated are well known: tax loss selling into year end, reversing in January, portfolio rebalancing by institutions, new capital allocations at the start of the year, all reasonable explanations. But explanations alone don't create an edge. Only data does, and that's where Seasonax is very helpful. So let's move away now from the theory and look at what the numbers actually show. Now, I'm going to be looking here, starting with small cap stocks, looking at the Russell 2000 ETF, right? So if the January effect truly exists anywhere, this is where we would expect to see it most clearly. But the data tells a much more nuanced story. You can see that over the last 25 years, January has been really quite volatile. The win rate is below 50%. The average January return, it's slightly negative. In other words, small caps are not consistently delivering a consistent January tailwind. Now, when the January effect works in small caps, it can work strongly. Look at some of these outsized years: 2019, 10% gain, 2023, 10% gain. But it doesn't work often enough to be relied upon. And if you look here at the standard deviation of the pattern, what this shows you is how reliable the pattern is. So typically, with seasonality, what we're looking for, we want a low standard deviation, because a low standard deviation is usually preferable because it means the historical pattern is more reliable, not just occasionally spectacular. But you can see here, a standard deviation of 6% just shows you that there's quite a wide variation in the pattern, and that's not what we want for a reliable seasonal pattern. Now let's compare the Russell 2000 ETF to large cap stocks, the S&P 500. Now here the picture does improve slightly. You can see the win rate is higher, 54.17%. Volatility, you can see, is lower. The drawdowns tend to be more controlled. But even here, average January returns remain, very modest, negative, in fact, far from compelling. So while large caps behave probably more smoothly than the small caps, they do not deliver a strong January edge either. And this side-by-side comparison is the real lesson, because what many people expect is small caps to surge in January, large caps to lag behind. But what the data has actually shown us is that the small caps, they've got higher volatility, right? Lower consistency, and a negative return. The large cap showed a slightly better consistency, but still a negative return and limited upside. So neither market offers a robust January advantage on its own. Same calendar month, but very different behavior. And that's exactly why seasonality needs context. Now, the reason this effect is so unreliable is simple, right? Seasonality doesn't operate in a vacuum. January performance is heavily influenced by the broader market regime. What's the risk appetite coming out of December? What are liquidity conditions early in the year? What are macro and policy expectations for the Federal Reserve? And in risk-off environments, seasonal tendencies can be completely overwhelmed. So how should traders and investors actually use the January effect? Well, it's not as a signal, clearly, but as a contextual tool. And seasonality works best when it helps you ask better questions. Does January strength align with the broader trend? Is risk appetite expanding or contracting? Does the seasonal tendency support or contradict positioning? And one of the most valuable insights from seasonality is knowing when not to force a trade. So this shows us that the January effect is maybe not necessarily a myth, but it is far weaker and more conditional than most headlines suggest. It highlights a potential historical tendency in some years, but it's certainly not a dependable strategy. So tools like Seasonax, we help you move beyond slogans, market maxims, and test these ideas across decades of data, seeing where they work, where they fail, and how they can fit into a disciplined decision-making process. That's how seasonality should be used, not as a folklore, but as evidence.